Hello everybody, welcome back to another episode of Real Talk with LoukProp. And as we all know, interest rates are going up really quickly, right? As of this recording, fixed rates have gone up to 4.25%. And for all of us homeowners out there looking at our monthly installments go up month after month, what should we be doing now to make sure that we can survive this high interest rate environment and make things a little bit easier on our finances? That's what we're looking at today. Let's go. So before we begin, let's talk about why interest rates are rising. Now, to cut the long story short, because of rising inflation rates globally, raising the interest rates actually raises the cost of borrowing, which in turn reduces consumption in an economy, and hopefully that will help to bring inflation rates down to more ideal levels. Now in the US, inflation rates peaked at 9.1 index rates in June of this year. But as of October 2022, index rates fell to about 7.7 index rate, mainly because of the rising interest rates, so it seems to be working so far. While it's great that inflation rates are being looked at, the fact that interest rates are going up is causing a lot of distress for homeowners and also for home buyers in the market. So what can we do about it? Let's talk about it in detail. Now firstly, since the implementation of TDSR in 2013, the issue of not being able to afford your monthly installments has more or less been mitigated, since it's mandated that you can only use maximum up to 55% of your salary towards all your debt obligations. So for most homeowners, the real issue here is whether the rest of your salary can be used to fund your current lifestyles with the increase of monthly installments. So the first thing you really got to do is to really relook at all your expenses, your savings, your finances to see whether you can set aside a buffer amount for any potential increase in installments. Typically, I will advise my clients to set aside a 3 years installment reserve fund for any rainy days. Now, some may suggest that you make a lump sum prepayment on your loan so that you can reduce your monthly installments, but for the moment, my advice would generally be to not do it that way because cash is still king. You want to have some form of liquidity on hand so that you can ride out any other adverse market events in the future. Moreover, for some of you savvy investors out there, you may be able to invest in some other investment vehicles that can help you to earn more than the interest that you are saving. For example, some of the banks' fixed deposit rates have already gone up to 4.2% in terms of return. So you can potentially put this amount of money into a fixed deposit in these banks to earn the interest and mitigate some of the higher interest rates you're paying for your property. Secondly, have your bankers reassess your current loan package and interest rates. In fact, some banks may have already contacted you or given you messages to do some repricing on your current loan package. This is beneficial in two ways. Number one, if your current loan has already gone up to like say 5 or 6%, it is definitely worth it to reprice or even refinance with other banks to bring your interest rates down to 3 point something to 4% so that you save some monthly installments. And number two, repricing and refinancing can actually potentially increase your loan tenure from up to 65 years old to up to 75 years old. Now, adding up to 10 more years into your loan tenure helps you to lower your monthly installments and lessen your debt load. In fact, for some of you out there who in the past didn't max out your loan tenure, now may be a very good time to do so. Now lastly, for current buyers in the market looking to buy your first property, especially for investors, consider buying a new launch property instead of a resale property. Now for resale properties, your loan is fully disbursed after completion and you start paying for the full loan straight away. This means that the interest portion of your monthly installments can actually be quite high. Now for new launch properties, however, because it is based on a progressive payment schedule, the loans are actually slowly dispersed over time as each stage of completion is completed. So let's take a look at an example, right? For a $2 million property, taking a $1.5 million loan at a 4.5% interest rates over the next 30 years. For a resale property, your monthly installment is going to be at $7,600 per month and interest starts at $5,625 per month. Now for a new launch property, however, your monthly installment starts from $478 per month and the interest actually starts at $333 per month. Now looking at 3 years down the road, for a resale property, you would have paid out $274,000 and of it, interest cost comes up to be about $197,000. For a new launch, however, you would have paid out $87,000, and of it, interest cost makes up about $62,000. By buying a new launch instead of a resale, you have saved about $130,000 in interest costs. However, whether a new launch is suited for your scenario or objective is really a separate discussion on its own. But if you're curious to find out whether you should or can buy a new launch, hit us up, contact us, and we'll arrange a one-to-one consultation with you to find out more. So hopefully these pointers help you to manage your finances a little bit better. And of course, if you want us to talk about other topics, let us know what you want us to discuss in the comment section below. If you like this video today, please go and like the video, share the video, and most importantly, please subscribe to the channel. It will help us a lot. Although we hate rising interest rates, there are things that rise and we don't hate one. Like this table.